What's up everybody? Welcome to the Stocks channel. My name is Cory and today we finished the week with another strong weekly rejection from the bear market resistance trendline. How much lower are we going from here? First up, let's take a look at the S&P500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so this week marks the second week getting rejected from this weekly bear market resistance, and I did do a video on this called Is the S&P 500 at a Peak? So I will link that video, and if you haven't already seen that video, there is a lot of very useful information about this bear market, and I do suggest you go check that video out. So with the second weekly rejection from this bear market resistance trendline, this is now looking more and more clear that the market is trying to continue to head lower, or at least retest the previous lows. Now keep in mind, every time we've had this weekly rejection, we've had at least 3 weeks of selling before a bounce, and sometimes we just continued to sell in a straight line without any looking back. So this is a very strong rejection, and I do want you to take it seriously. There was a lot of chatter about this being way too obvious and it wasn't going to work this time, and now that it's undeniable and it's objective that it very clearly did work this time, and this is still another very strong rejection from this level. Alright, so let's switch back over to the daily chart, and we can see with today's daily chart there was a very significant sell-off today because we did close the gap down here at 381, and we did close very oversold below the lower Bollinger Band. Now this is very significant because there's two things I want you to pay attention to. Is we opened yet another gap that did not fill to the upside. So we now have two gaps at 396 and 387, and these are starting to look like breakaway gaps. So if we take the weekly chart rejection and we take the daily gaps opening up and we're closing outside the lower Bollinger Band, this tells us two things, and it tells us there is a lot of selling pressure and a lot of buyers refusing to buy at these levels because they more than likely think they're going to be able to buy at lower prices. Whether or not they're right is to be determined, because if we don't bounce very early next week and start pushing through some of these gaps, the bears are going to use those as resistance levels and try to drive price lower. So there is a very good possibility, and I don't normally suggest trying to plan for these events, but this is going to be a possibility where we do start crashing down next week because there is so many motivated sellers and very little buyers. We could just continue to flush down and ride that lower Bollinger Band. Now the good news is after that happens, we could see a very strong bounce back up towards that resistance. And then if we are going to continue into the bear market, we'll likely start trending down towards retesting the previous low. So next week, there's two things I want you to pay attention to, and that is whether or not this gap at 387 fills early in the week, or if we continue to see strong selling pressure. If on Monday we continue to see selling pressure and we cannot see any buyers around this zone at 381, then we are very easily going to 378 all the way down to about 374. It should happen very quickly, and we should be very oversold by the time that happens, giving more possibility for that dead cat bounce back up towards resistance. So just be aware of that weekly chart that I went over in the introduction, because that is what's driving the selling pressure, and the weekly chart is much stronger than the daily chart. You can see there's plenty of high volume selling, and we're not seeing very strong bounces. So whether or not that buying pressure comes back into next week is going to be determined very early in the week. So just pay attention to the price action on Monday. If we instantly start seeing buyers and we go up and close that gap, we will need to break over this critical resistance around SPY 390. And then above SPY 390, the bulls are getting a little more traction and then can try to continue to push towards that gap fill at 396. But if you just look at the price action, we're below all of the moving averages, and all of these moving averages have negative slopes. So without a doubt, you should be expecting lower highs and lower lows after this very strong rejection from the bear market resistance trendline. So treat that rejection with the respect that it deserves, and without a doubt, it is very clear the bears got that double top rejection at SPY 408 and are trying to drive price lower while we're below 390 and 393. On the Nasdaq 100 triple Qs, we were down 0.95%, and the triple Qs confirmed the breakdown below the neckline at 280, which is now giving the bears even more confidence. This is a double top rejection from 293 with the price target at the gap fill at 268. Just like I went over as SPY, if we crash right down through that gap like it's not even there and continue to ride the lower Bollinger Band down, we will be looking for a retest of the 52-week closing lows at 260. Below that, we can flush down to brand new 52-week lows, but that is going to be the valid price targets to the downside at the gap fill at 268 and the retest of 260. To the upside, the bulls need to break back over critical resistance at 280 because that's the neckline for the double top. So as long as the bears have the triple Qs below 280, they are still in full control. Above that, we have the gap fill at 283 and the strong resistance at 288. And this is still a bear market as long as we're below 293. In the Dow Jones, we were down 1.15%, and we see the Dow Jones closing below the 50 EMA and holding just above the resistance trendline breakout, which is that support right around 328. A break below 328 sends us down to the next strong support just below 325, and that is going to be the test of the 200 daily moving average. So look for strong resistance to the upside right around the low 330s, and then above that we'll have strong resistance between 335 and 337. On the Russell 2000 IWM ETF, we were down 0.75%, and the Russell 2000 is also looking very oversold outside the lower Bollinger Band for the second day in a row, and we're well within the double top price target that we had at 176, now more than exceeding it with the close at this daily support right around 174. Below 174, we're looking to go all the way back into the 160s, which means we more than likely will see that crash event where we ride the lower Bollinger Band down and continue to flush next week. So I continue to tell you next week has a lot of downside risk with these weekly rejections, and the bulls need to immediately get back over these critical risk levels at 178 and right around 182. While we're below all of this critical resistance, the small caps can continue to go lower with the lower highs and lower lows that define this bear market downtrend. On the ARKK ETF, we were up 0.12% today, and ARKK is trying to hold above the previous 52-week low of support at 32.5, and we are starting to see the volume dying off. So there is going to be the possibility that the ARKK ETF does bounce off of the previous low. However, if we break below that low, you're looking for the next leg lower at 31.3 and $30, with the strong resistance level at 34.6 and 38. If we can get above 38, this is going to look like the bear market could be ending in the short term, and then we could make an attempt to run up towards the 200 daily moving average, but we're not getting bullish until we get that breakout above 38. On the VIX, we were down 0.92% today, with the VIX failing to break out above 24 and having the red close today, so we're definitely not seeing the VIX confirming a lot of fear in this market, which is going to favor the bullish scenario of bouncing from these support levels and these oversold conditions. However, the VIX can move very quickly, and if we start to crash down next week, expect to see the VIX spiking back above 24 and then trying to get back up towards 30. On Bitcoin, we're currently down 3.07%, and Bitcoin lost the support trend line and is currently trading below the 20 daily moving average, which is increasing the probability it's coming back down towards the support at 16,000. 16,000 is very strong support, but if we lose that level, we will be looking for the next leg lower at 14,395, and the critical resistance remains up here at 17,550 and 17,800. On Amazon stock, we were down 0.67% today, and Amazon is still below all of the negatively sloping moving averages and starting to break down below the support at 88, but only by a few cents, with critical support just a little bit lower at 86. You could try to stay bullish above 86 if you think there's going to be the possibility of a double bottom, but on a break below 86, we are more than likely getting the next leg lower to 77. The bull breakouts will be above 92 and 97, so we'll get a lot more bullish if we can break above that resistance, or if we get a strong bounce from 86. On Microsoft stock, we were down 1.73%, and the price action is back down below all of the moving averages and just barely above the critical support at 242. A loss of support at 242 means Microsoft is more than likely going down to fill the gap at 228, so that is going to be a potential short trade on a loss of support. Critical upside resistance remains 252 and 255, and if we could break resistance, we will be looking for the gap fill at 265. On Nvidia stock, we were down 2.25%, and Nvidia did close right on top of this rising 20 daily moving average around 166, so that does increase the probability we could see the selling pressure dying off while we get a dead cat bounce up to fill the gap at 174. From there, we could still get a rejection and continue the downtrend back down towards support at 155. So look for that critical rejection around the gap fill or the break of support at 166 to send Nvidia back down towards the critical support. If we lose critical support, we could likely fill the gap at 142, and if we continue to blast off higher and break the resistance at 179, we will be looking for a bull run into the 190s. On Tesla stock, we were down 4.72% today, with Tesla breaking through that support at 155 and getting very close to our double top price target at 138. I have that arrow arriving by Monday of next week, but we never know for sure when we'll get there or if we'll even get there at all. So while I do have that as a valid double top price target, that's only valid while we're below the neckline at 168. So for that reason, you need to be very cautious in Tesla while it's below 168 because it could still be trying to get down to 138. Look for 156 all the way up to about 160 to act as resistance, and then above that we'll be looking for resistance at the neckline at 168 and 173. And keep in mind, this could still go lower than my price target, but that is the destination that we currently have set. On Apple stock, we were down 1.46% as Apple closed the gap yesterday at 138 and continued to flush down lower today, closing outside the lower Bollinger Band for the second day in a row and barely closing below support at 135. So this does look like we are going down to close the gap at 133. Once that gap closes, we could see a bounce all the way back up towards 138, all the way up to even 142. So you can get a lot more bullish if we start to bounce off of 133. Otherwise, look for the next price target down at 130. On the financials, we were down 0.77% as we continue to flush to the downside after that critical resistance rejection. And we still do have the gap to fill to the upside right around 34.5. On the financials, we were down 0.43% today outside the lower Bollinger Band. So we did get the dead cat bounce and we're getting very close to closing the gap at 97. The healthcare sector was down 1.45% today, losing support below the 20 daily moving average and now has a gap to fill to the upside at 137. And you could stay bullish as long as we're above this critical support at 134. The energy sector was down 1.23%, still holding on to that support at 84, but once we lose that support, we are expecting a trip down to the 200 daily moving average at $80. So jumping back over to the S&P 500, it's very important you understand the weekly chart rejection from the bear market resistance trend line and understand there's still a lot of downside risk going into next week. So there's a lot of talk about Santa Claus rallies and seasonality, and you can throw all of that in the trash can because it's only important that you follow the trend and the price action. While you can be aware of seasonality, you can't ignore what the chart is telling us, and right now the chart is telling us we have a double top rejection from the bear market resistance trend line. So respect the price action and always remain unbiased and have great risk management. Also, don't forget I have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. I think now is the best time to be a bank member, and you can learn more or learn how to subscribe by clicking on the link in the description of this video. If you're looking to become a better price action trader, come join us at the Stocks Channel Trading Discord community where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.